In this tutorial, we're looking at the main financial reports, which are located on the Accounts listing screen. So if we go to Accounts, you'll see these listed on the right-hand side. We'll be looking at the main profit and loss report, the manufacturing report, the balance sheet, and the trial balance. We'll also look at the year-end tax report in this tutorial, but the VAT returns will be looked at in a separate tutorial. So if we start with the main profit and loss report, we simply click P&L Report. Specify dates at the date range for the report and click Generate Report. You'll see for the first 3 months ended 31st of October, this business has sales of £282,520, has made a gross profit of £31,996.49 and a net profit of £24,413.16. We can, however, look at not the total business but a specific project or department. If we select, for example, Projects and then the relevant project, then generate the report, we'll see that the project on a standalone basis will have made sales of £10,500 and, having incurred costs of £7,350 in the same period, will have delivered a gross profit of £3,150. This particular project has not been flagged as complete, and we can generate this report excluding the value from any incomplete projects. And here you'll see that the sales have been reduced for the period to exclude incomplete projects, as too have been the costs, the gross profit, and the net profit. This therefore gives a truer representation of the business's real performance, given that it deals with only the projects that have been completed. If we now look at the manufacturing report, we go to Accounts, then Manufacturing Report, and specify the same date range, then Generate Report. We can see that the business performance is presented in a slightly different way. Sales are, as before, £282,520. The material cost is broken down between 1. The material stock value of the sales, which the application calculates each time a sale is dispatched and invoiced. 2. The production variance, which is the difference between the material stock cost of components issued to works orders and the material stock cost of the stock items manufactured on those works orders. 3. Stock adjustments, which is the net stock cost of items found or written off in the period. 4. The purchase price variance, which is the value of supplier invoices over and above the stock value of the stock item bought. This is calculated each time a supplier invoice is processed. In the same way, each time dispatch and invoice is processed, the application calculates the subcontract stock value of the items sold. As with materials, it also calculates a production variance, which is the subcontract stock value of any components issued to works orders, plus the supplier invoice charges in the period for subcontract charges, less the subcontract value of stock produced on the works orders in the period, and similarly any stock adjustments and any other charges made within the period relating to subcontract charges. Also, on each dispatch and invoice processing, the application calculates the stock labour value of the goods sold and a production variance comprising of the labour stock costs of components issued to works orders, plus the actual wages and on costs for staff in the period, less the labour stock value of stock items produced on the works orders. And finally, the labour stock value of any stock adjustments made which together comprise the direct wages costs. Any other direct costs are included here, and together the materials, subcontract wages and other direct costs are totaled, which when taken away from sales brings us back to the same gross profit that we saw in the main profit and loss report. This report has the same options as the main profit and loss report to include a specific project or department only, or exclude incomplete projects. If we now look at the balance sheet report and select a date at the end of the period we've just reviewed on the profit and loss report, and again generate report, the first thing we'll notice is that the current year profit and loss figure on the balance sheet is the same as we saw on the main P&L report. The balance sheet keeps a complete record of all financial affairs of the business from the date it starts right up to the current date. For further details on the structure of the balance sheet, you can look at Help Documents, Accounting Basics. However, briefly, the balance sheet includes any fixed assets, including plant, machinery and vehicles, for example, that are used in the normal course of the business, any stock, any amounts owed by customers, any bank and cash balances, and in this case, taxes due to the business, creditors or sums due to suppliers or employees by way of wages. You'll see that the net of all these assets and liabilities is summarized here as capital employed, and that equals the shareholders' funds, which in this case comprises entirely of the current year's profit and loss. And in the same way that we can exclude incomplete projects from the profit and loss account, we can also exclude them from this balance sheet. So if we click Exclude Incomplete Projects and again generate the report. First, you will see the current year profit and loss has changed in line with the figures that we saw in the profit and loss report. A project work in progress balance has been added to the asset side of the balance sheet, and this will be the costs associated with the incomplete projects. Also, deferred projects income has been added to the liability side of the balance sheet. This is essentially the sales which have been made into incomplete projects. Next, if we briefly look at the trial balance report, this is a simple listing of all account balances at any given date. So again, simply select the date and generate report. And all the account balances are then listed. And finally, if we look at the year-end tax report, we'll see that this defaults to the year-end date that we specified in the company settings, and that all incomplete projects are excluded as a matter of course. You'll therefore recognize the sales revenue figures, gross profit and net profit, which we saw in both balance sheet and the profit and loss account when we clicked on the Exclude Incomplete Projects box. In this report, however, it doesn't stop at net profit before tax. The report then goes on to calculate the main accounting adjustments that are made to the operating net profit to arrive at a profit for tax. For example, this will include adding back items that are disallowable for tax, but it will also adjust for capital allowances and other tax breaks in arriving at the profit for tax. You can see that in this case the profit for tax has actually become a loss because of the inclusion of £50,000 worth of annual investment allowance on plant and machinery that was bought in the year. In addition, there are losses brought forward from a previous period, which can be taken here, or, if not, they can be carried forward to the next financial period. And finally, we get a net profit for tax purposes. And where the business is flagged in the company settings as incorporated, there will be a tax estimated, calculated here, and you can see that that is based on corporation tax rules. If we flag the business in the company settings as not incorporated and we rerun the tax year-end report, you'll see that the sales revenues and profit figures haven't changed, and that most of those adjustments are as they were before, but you'll see that a different tax calculation is made here based upon the appropriate tax schedule for individuals. Clearly, these are tax estimates, and you should consult an accounting professional to ensure that your tax returns are correctly made. By clicking this button after determining that no further adjustments to the tax year-end report are to be made, the tax return is processed. This will do two things. Firstly, it will mark all the transactions that were included in the tax return so that they don't appear in future tax returns. And secondly, it will update the next year-end date in the company settings. Running of the year-end tax report will not prevent the rerunning of either the P&L report for a previous period, nor will it prevent the rerunning of the balance sheet.